Welcome, Kerwin. How are you?
Doing well. How are you?
Very good, thank you. Retiring the stock market at part 2, session 7 with Kerwin. It's April 7th, 2024. Your question about Reddit. What about Reddit did you want to talk about?
The option chain. The prices are pretty high right now, so makes it good for writing cover calls. But will the prices stay that way, or can I expect them to kind of start trickling back down, or would it be a dump of them and they're just all of a sudden they're super cheap? So because I was looking at that yesterday, I was just kind of trying to figure that out. But I'm gonna write the call either way. But
Yeah, good question. I saw that you got like 14% return on your cover call for 6 weeks.
right.
Is that right?
Yes.
So yes, that is inflation. There is a lot of hype right now on Reddit, being that it's an IPO, being that there's a lot of coverage right now on that one. A lot of people betting, a lot of option traders betting it's going to go up and also go down, both calls and puts, and that inflates the prices on those options by at least a few percent. If it was going to be 5, it's going to be like 7. If it was 7, it'd be 10, and if it was 10, it'd be 14.
Right.
You can expect those to cool off in the coming, let's say within 6 months. However, you never know, because time will tell.
Right.
And with Reddit, because what price is the stock right now?
40. I think it was like 4. I think it closed like 47 and some change. I have to look and see the exact price.
RDDT, Reddit, 47. So the thing with Reddit is, because there's a lot of hype and exuberation, I say, the stock may move a lot. For example, if you wrote, what did you write, to 50? Wrote to 47?
I wrote 47.50. Yeah, I wrote the
47.50 for May, and
yes.
it been April. That's around 6 weeks.
Yes.
And you got 14%, correct?
Right.
What was your premium on that, on the 47.50?
6. What was it? 6. Man, let me see. Let me look. I don't want to tell you wrong.
$6.
It was $6.90.
$6.90.
Yeah.
Almost $7. And then you remember what you bought the shares at? 100 shares.
46.79.
All right. And you know what the daily change was for Friday?
What was the question again?
The daily change in the stock on Friday.
Oh,
I always look at that.
Went up $1.78.
So what was the price?
It closed at 47.56.
Okay, you did good because you got the 690 premium. However, you did not allow for a lot of share growth.
Right.
I always try to teach the sweet spot, which is to say that making sure the share growth equals the premium, and that's to say that you have more upside potential, not a guarantee, but a potential for the stock to go up, and you make more money in the stock, also getting a good premium, which in this case would have been for you to write to 50, because that way you have a purchase price of 46.79 on the stock. If you wrote to 50, you would have got 321 share growth, which is nice, and then the premium probably would have still been $5.
It was like 560 if I remember correctly. I remember looking at it. So
yeah, okay. However, you got 690, so I can't complain. I mean, that's really nice premium.
Right.
But like, think about over time. If Reddit did go up, you benefit more from allowing more share growth and just a little bit less premium, because it's like a gradual scale. you can go in the money and get more premium, but then you start losing your share growth. Make sense?
Right.
But anyway, it's a good trade. And so the challenge you're going to have is to stay with the stock. Because why? Because let's just be real. Let's just say it drops to 40. Okay.
Mm-hmm.
So now you have 6.679 share growth loss.
Right.
690 premium, which is a total gain of like 19 cents, which is actually okay if you think about. You're battling. It's a battle. You're
Right.
you're fighting with the stock. You know, you're like taming the stock, like you're uh training. You're training it to do what it's supposed to do. And you're getting premium month to month to month to month. And that's the important part. Premium has to be consistent monthly. Don't wait. Don't like try to be like, oh, I got stuck in the stock. I can't write till it's off. Don't do that. And then what you're gonna have to do is for the month 2, you can write to 45. Okay.
Right.
Now some novice traders will be like, wait a minute, I bought the stock at 46.79 just a month ago, and how am I going to write the cover call for the 45? Then that means I'm agreeing to sell the stock at 45, which is a 179 loss.
Right.
Follow me? But that's fine because why? Because you're gonna get another 690 premium, or let's say 6 premium, or 590, or something like that. With Reddit, it might be 7, 8, 10% for 30 days.
Right.
And then month 3 comes around. Let's just say it goes back up. It goes back up to 46.79, exactly where you 46.79, exactly where you bought it. And then that 45 call gets assigned. So it sells at 45. So technically you're gonna have that 121 loss in the share growth. But you have what? 2 months of premium. First month 690, which is 6 weeks, which is fine. I always say 3 to 7 weeks.
Right.
Week 2, month 2, let's say you got $5 conservative. So now you have 1190 in premium. This thing is about to go into cash cow pretty soon. Right. Meaning that once you get 100 premium, that pays for your investment. Your investment paid for. You got income coming in monthly. Cash cow. Did we review that last time?
We did, yes.
And then let's say, goes right back down to 40. See, this is what knocks out a lot of regular people, a lot of novice traders. Like, it was up, it's down, it's up, try to buy more, pull your hair out, Meanwhile, what? Cover call writers are getting this premium, bam, 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 paying your bills, paying their water bill, paying their mortgage, Month 3, let's get another $6 and $5. You see, it could go up to 50 now. Let's say it goes up to 50, okay? Or even 55, let's just be real, okay? Because that can happen. Oh, yeah. Now, you're going to have to, lesson 1, let it get assigned, okay? Just let it go. Don't pay money to get it back because that's just more mental gymnastics. But now you have to, so let it go at 45 or 50, but then you have to buy back at 55. So your cost goes up, okay? Right. Sometimes what will happen with the cover call writers is their stock will shoot up and it's so expensive to buy it back, they can't even buy the shares. Right. So they lose the shares. You might have to sell something else to get those shares. Or you might be like, you know what? I can't even buy it back. It's too much, So then you have to trim back your cover calls from 3 calls to 2 calls to 1 call, Back in the day, I remember I had 7 calls on Netflix at one time. Back in the day. Now I have 2. So point being is, roll with the punches, tame that pet, keep with it. And in this case, so you're paying more for it at 55, but still, that's your business. That's your income. Right. You can still get it. You can still buy it. So it's not a loss. I want to be very clear. When you buy back your shares for more, parentheses, higher cost, it's not a loss. But you have higher costs. So like if you're getting you know, it's costing you more money. See, sometimes we equate this to stuff in real life, but it's not exactly the same, because if you're getting 6%, or in this case, in your case, 14% for Reddit, okay,
Right.
that's a percentage return. It's not a dollar amount, all right?
Right.
And you're getting at $50. Your purchase at $47, close enough. At
Right.
$47, okay, you're getting 14%, okay, return. That's your business. That's your income.
Right. Right.
Getting 40% return every 6 weeks on a cover call, or monthly, right? If you have to buy it back at 57, okay, you're still gonna get about 14%, Kerwin.
Right.
So the return is exactly the same in that way.
Right.
It might be 12% or 15%, depending on what cover call you're at. I'm trying to tell you to a little more share growth.
Right.
And in the long run, you're going to get a better return, but not going to complain again. So it's not the same as if like inflation. It's not the same as inflation as if you had to buy eggs for $3, before COVID, and now they're $5 or $6 after COVID. See, because they're just eggs. They're the same.
Right.
But it's not the same for Reddit or for an increased stock price, because you would have still expect to get that 14% or 6% or 8% or 5% return. Usually for a cover call, you're getting 3 to 4% return, but just 3 to 4% return on CC per month. So in the case of Reddit or any of the stocks we're buying back, we're still getting the same return. So it's not the same as eggs going up or inflation, because our return is actually equal, but it's costing us more. So there is a cost associated with that. We're going to end up having to cut back our contracts. We're going to end up having to cut our shares back, and then we go from $500 a month, or if we have 3 contracts, we're going from $1,500 a month down to $1,000 a month, down to $500 a month. You see?
Right.
So not the same as inflation. It's not a loss, but there is a cost it's a higher cost to buy it back, to pay more to get it back. Has to do with how many cover calls we can write in our account, or naked puts. Have you done naked puts?
I haven't looked at them. Yeah, I haven't wrote any.
Naked puts are basically very similar to cover calls. It's a long position. Write down naked puts, long position. Write that down. Naked puts, similar to CCs, both long position. So if Reddit is 47, right, you can write the 45 or the 42.50 naked put, okay, which is to say that you're willing to take the stock if it goes down to 45 or 42.50, but the thing is there's no share growth on this one, okay?
Right.
There's no share growth. But you're gonna get a premium. The premium is gonna be the same as the cover cost. Let's just say $5 to $7, okay?
All right.
Let's just say $5. It doesn't have to be high return in this case. And then you're gonna just have that option. There's no shares. So that's why I said naked. There's just naked, there's no shares.
Right.
The naked part is to say that if the stock goes down to 40, right, you're gonna have to buy those shares at either 45 or 42.50, which whatever strike you wrote.
Right.
Take a look at the puts, not right now, in your time, and look how the price changes as you go farther down, and kind of like the calls, except it's opposite. So
Right.
back on the put, if the stock stays 47.50, and you're right in the 42.50 or the 45, it expires worthless. You get the premium every month, month to month to month, no issues, income, and nothing happens. But the moment the stock drops is when you are assigned those shares at either 45 or 42.50 in this case, and then you
Right.
own shares. So that's the difference of the naked put. When there's an assignment on the cover call, they sell. When there's an
Right.
assignment on the put, you buy them, right?
Right.
So it's kind of like that's where they get this wheel strategy. The wheel strategy, like I don't even like to use that because I never teach that, but people are teaching that. Is the first thing you do. You get a stock you like. It's a wheel strategy. Write a naked put on it, or write a put. There's also cash covered puts. If your level trading is 3, you get naked puts. If your level trading is 2, you get cash covered puts.
Right.
Similar, but the cash covered puts is you have to put more money up. You have to put money up to buy the stock right away. So it's like covered. But the naked
Right.
put, they only charge you 1/3. Naked put NP 1/3 requirement.
Oh, really? I didn't know that.
Yeah, naked put is 1/3 requirement. Write it down. Which is why it's naked, which is why it's better equals better. Why? Because you can get that 14% return you got, and only putting up 1/3 the cash. Okay, now here's the tricky thing with that. If there's an assignment, you got to have all that money to buy the stock. So in a way,
Right.
it's like good and it's bad because you can get behind the 8 ball. You can be like, oh, I can write 3 covered calls, but I can write 4 naked puts. You see,
Right.
or 5 naked
Right.
puts. But if that stock gets assigned, you have to buy those shares, and then if you're overdrawn, if you're in margin, you would probably just have to just close a position right away. But here's the thing,
Right.
Thorne. Here's the downside of naked put. Let's say the stock gets slammed. Let's say it goes to 30, right?
Right.
And you're up here trying to trade ready at 46. You write to 45. You get the stock go down to 30. You get that buy the shares at 45, and then the share price is 30. You're out 15 points per contract. Per contract. So
Right.
if it's one contract, that's a $1,500 loss, and then you add your premium 500, and then you're out 1,000. But if it's a 2 contracts or 3 contracts, because you thought you were smart, now it's 3,000, $4,500 loss, and then you add your premium, 4,000, 3,500, 3,000, still a big loss.
Right.
So that's where you can get in trouble. Where they could put you write more contracts because you can, because they allow you to. Because it's naked, because you have level 3 trading, not level 2.
Right.
But when the stock gets slammed, now you're behind the 8 ball because now you have a bigger loss.
Right.
So play with it, work with it, but stay with the cover calls until you get very, very comfortable. So people do both.
Right.
Okay, there's 2 more lessons on this part. On lesson 9, I want to teach you about straddle, my favorite position, which is where you write the cover call and then they can put the same time, same stock, same position.
Really? Okay.
Yeah, that's my favorite trade. Don't want to get ahead. Back to the cover calls, great strategy. Your challenge is to stay with it. Look at the naked puts because you do want to have that option. And that real strategy, which I don't care for, is get a stock you like, write the naked put. And then if it gets assigned, first of all, you're getting premium month to month to month to month. That's important. You're always building for that cash cow. Okay.
Right.
But on the premium, on the naked put, let's say for Reddit, you write to 45 or 42.50. If the stock stays the same or goes up, nothing happens. Keep writing naked put month to month. But if it drops now, and here's what they sell this. This is a sales point. You get to buy the shares for cheaper because it drops. You get your premium, and then since you have the shares, now you write the cover clause. So real strategy: write the naked put, write the cover call. The thing about that is, I always think that if you want to write the cover call, just buy the share and write the cover call. Don't be like waiting for it to be assigned on naked put. Again, there's no share growth on the naked put, just premium. So you don't have a share. But here's the thing: there's no loss on the share growth either. So if you have a cover call, at 47 ready, stock goes at 50, you write the 50 strike. Great, you got 250 on the 221 on the strike, the share growth, $5 on the premium. Great, but they'll make it put just the premium. But again, if stock goes down, let's say to 40, now you have a $7 loss on the share growth. Still get the premium of 5. You end up having a loss of 2. Right. But on the naked put, if you read it at 47, and you write it at 45 or 42, even though you do get assigned, your share growth losses, it doesn't happen until it gets assigned. So a little different. Right. In the case of the naked put, if the rate is 47 and it goes to 45, no share growth loss. If it goes to 44, you have a 1-point share growth loss if it's assigned at 45. You follow me? And then you add your premium of 5, and you have a $4 gain. Just play with it. So when we're getting, I want to be clear, when we're getting 5% or 7% or 10% or 14% return on these cover calls, the truth is you won't have the entire gain, because there's going to be some months where stock's going to drop, and you're going to have some share growth loss, and you're going to be thinking, what cover call do I write now? Right. First lesson: just write the cover call. Always, even if it's a lower strike, stay with the stock. Try to tame it, month-to-month income. You got to accept. You got to accept some loss on the share growth, because that will happen. But over the time, month to month, let's say we do 10 cover calls a year or 10 naked puts a year. That's the consistent income that's going to get us paid, pay our bills, to get us to that cash cow position. And the cash cow position, I didn't say it, but we said before, you get to the point where you can't lose. Right. Because the stock's already paid for, you're still making money. The stock can go to 0 and you can't lose, because all those premiums you got, you add those up, you're still at a gain. Right. Is that too much?
That's the goal. That's what I'm trying to get. So,
all right, so stay with Reddit if you can. Do another 100 shares. In a couple months in June, we're gonna get Chipotle, probably at 60 or 65, or 70. We don't know, 70. My Chipotle is one of those. I had those irons in the fire. Been talking about that for years. For years. Yeah. Really? I don't know if you know, but I always liked Chipotle. I remember stock was like 500. Back, I remember being in Kaiser, and I was talking to a client at Kaiser in the hospital, like a routine appointment. $500 for Chipotle. That's way too high. Went to 3,000. Now they're gonna split 50 for 1. So was it really too high?
Yeah, right. No, it's held its value, so I don't think so.
And Chipotle, symbol CMG, may open up 500 more stores. Hello. So a lot of room for growth. Yeah. The next McDonald's, they say organic McDonald's.
Yeah. They actually just opened one up right down the street from me. Brand new store. So they're opening them.
They have a good corporate what's the word, system, I guess. They have very good customer service training.
Right.
Their food's decent, and their system is good. I remember in COVID, my local Chipotle was the only store that didn't close. They never closed.
Really? Huh.
Yeah, they did. They went right when the shit hit the fan. They went right to delivery.
Right.
So they closed. They had to close the restaurant,
Right.
but you can still order online. You still deliver through Postmates.
Yeah.
Same name as
That works.
Starbucks, they had the drive-through. You know, when Starbucks had its first drive-through, right?
Right.
A coffee shop, which they never had drive-through.
Right.
We're like drive-through for Starbucks. That's stupid. Like, what are these people? Why do you want drive-through? Damn line is down the block.
Yes.
You know.
Yes, it is.
And then COVID hit. Bam, like a line 2 blocks.
Yeah.
Which is almost a little too suspicious. Wait a minute.
Right.
Get a drive-through. Now that you have to use a drive-through. Wait, is
Yeah.
that just lucky?
Yeah. Right.
All right. Questions.
I'm good on questions on my end as far as this goes.
Speaking of Starbucks, symbol SBUX
Right.
has come down in the last year. I think
Yes.
it was like $88 or something. I remember trading it at 109. So
Right.
the Starbucks cover call is not great. It's only about 2.5%. Okay, per month.
Okay.
CC, the Starbucks, 2.5%. So you're getting probably like 7% on Reddit, okay, or 10%. Okay. So way more on Reddit. But Starbucks, what? It's a bigger company.
Yeah.
There's gonna be less roller coaster than Reddit.
Right.
It has a dividend. I think I'm gonna say about 2% dividend, small dividend. So it's a different kind of company, different kind of trade. I was teaching my clients to trade Starbucks. It was moving about 6 points up, 6 points down, +6, -6. 4 points up, 4 points down, 8 points up, 8 points down, and now it's just down. So I think
Right.
Starbucks will come up. Speaking of Starbucks, I think it'll probably come back up to $100. So write it down. Starbucks, $100 target price, which I think is a good buy now. If it's 88, whatever it is, I didn't check Friday. But like I said, very small return on cover call, very small dividend. So different kind of trade on that. You can do the monthly trade on that, buy here and sell when it goes up 2 points. When it dips, buy. When it goes up 2 points, sell. That's the trade on Starbucks. Chipotle, just wait for it to split in June, and then hopefully we can do a nice cover call. So you're going to compare the cover call on Chipotle to Reddit. So say with Reddit, instead of getting 10% returns. Oh, on the sweet spot. Again, if you're doing Reddit and you have a 47 stock price, if the 50 is paying, $5, that gives 3 points of share growth potential on the stock price, and then 5 points on the premium. That's a total of 8 maximum. So in that way, it's better. So try to give some room for share growth, because if the stock goes up, you're going to end up getting more. So you can compare Chipotle to Reddit when it splits, but I'm gonna just guess that Reddit will still pay more on the cover call, but Chipotle will be more steady. Okay.
Yes.
Chipotle's not gonna have that wild swing. Like I said, Reddit can go to 40 or 55. Chipotle is gonna be more stable because less hype, been around for a long time. Reddit is an
Right.
IPO, so people are betting. They just bet,
Right.
you know. So we talked about 3 stocks: Chipotle, CMG, Starbucks, SBUX, and then Reddit, RDDT. Back in the day, you know, you could buy an IPO and you can kind of, and they would start at a lower price. And you can kind of bet that it will go up, and they did go up. So you can make money on most IPOs. Nowadays, Kerwin, that's not the case. When you talk
Right.
about Reddit, you know, they raise the price way up when they start. They did that to Facebook, and Facebook went down for like 9 months. It took 9 months to recover the IPO price on Facebook. So nowadays, these IPOs they're overpriced, and you don't just get them because they're IPOs. Get it because
Right.
you have a
No.
strategy, you know, cover call.
Yeah.
What's that?
Yeah. And that was the whole purpose of buying Reddit was I was looking at the option chain and seeing that how well those their how their option chain was. So that was the reason I wanted to buy shares. I don't know how fast or how low they're going to drop, but I'm gonna write the cover call either way. So
Yeah, and always look at the volume. Can you see the volume on the actual options? Can you see
yes,
the volume on each strike?
yes,
Um, so more volume is better because it's going to give you a tighter bid ask. And on these options, you know, I got to tell my people, don't just do a cover call because there's an option chain. Some of these cover
right,
calls are, you know, $4 by 650, which is a huge spread, which is not desirable. Because why?
right,
Because you get $4 for the cover call, but you have to buy back for 650.
right,
That's a 150 loss just trading it. Now, the first lesson is don't buy back anyway, so I want to cover that. But um, let's get to this next week. Buying back the cover call. Why would you want to buy back the cover call? One reason to buy back the cover call is that you wrote Reddit at 47.
right,
You bought it at 46.79. But now the stock's going up and up 50, 52, 55. It's just on fire.
right,
So you can get back all of the money that you paid into that cover call.
right,
Give all the premium and then pay more money, meaning that you might have to buy back for $9. But here's the thing: you get to hold onto the shares, okay?
right,
And now when you buy it back, guess what? You know, you're buying back all that share growth because if you bought the stock at 46.79, you wrote the 47.50. You agree to sell those shares at 47.50. You don't get paid more than that. You
right,
follow me?
right, right,
When you pay $9 or $10 to buy back at 55 or 52, whatever the price is, you're giving that $1,000, but now you own the shares at 55 or 52. See, now you own all that share growth. So it doesn't really cost you more. Write this down. It doesn't really cost you that much more. It doesn't really cost you that much more to buy back your CC higher because you are buying back all that share growth. It doesn't really cost you that much more to buy back your CC higher because you are buying back all that share growth. So when you do have to when you do buy back, you might say let it expire, you know, and then wait, see if it dips, buy it back. But if some
right,
people buy back their cover call because they don't want to get away from them
right,
because they don't want it to be so high. Because what? Because let's say Reddit was to go to 60, you know. Well, hey, I wrote the cover call at 47.50. I got 690, great. But now it's 150, 52, 54. Let me just pay $10 or $12 to buy it back, right? But now I own the shares at 52.60. I'm sorry, at 52.54. And then if it swings at 60, I get all that share growth, you see?
Right.
So it's like you're betting on the future. It's a tricky trade. I'll talk more about next week, but it doesn't cost you that much more because when you buy it back, you get all that share growth back. But it's an option. We have options.
Yeah. Right.
Question on that.
So do you say a stock that you buy, say solely for the right cover calls, do you just buy some other shares and not write cover calls on them, or do you write cover calls on all of them, on all the shares that you bought for that reason?
Both are true. Ideally, you're getting income. You're getting income, money every month, right?
Right.
So let's say you have Reddit, right? So Reddit's at 47, 47.56. So you buy 100 shares plus 100 shares, you're right to 50. But now buy another 100 shares. You have a couple options. You can not write the cover call. Remember I said to write half your cover calls on pounds here?
Yes.
Remember I said that? But then the stock
Yeah.
started going down.
Right.
So the better you write all the cover calls.
Right.
Because that stock's going down now. Those cover calls are going down. You got your
Right.
money in hand. It would have been a better trade to write all the cover calls.
Right.
But if the stock were to go up, so now you get the share growth, right? So a regular investor with 100 shares of Reddit wants it to go up. You don't have a
Right.
cover call, you know.
Right.
When it doesn't go up, here's the thing. It's not going to go up every month.
Right.
But the cover call will come in every month.
Right.
So that's why cover calls are better. But so the next 100 shares, maybe wait and see if you can write to 52.50. See that?
Yeah.
So you can straddle them. You can write 100 shares, one contract on the 50, one on the 52.50. You get a third one, you can write to 55.
Okay.
You can wait and write to 50 because it starts going up. Now I'm right to
Right.
55. You see? So
Right.
you taper them, you know, on the first one, you're getting 6%, 14% return. On the 52.50, you're getting 10% return. On the 55, you're getting, 5% return.
Right.
But now you have all that share growth potential. See?
Right. Right.
And we are still in the bull market.
Right.
I don't see no crash coming right now. So in that sense, we're going up. Play the upside. If we're in a bear market, if we're crashing, if we're going down, play the downside, buy puts.
Right.
On the cover calls, the strategy is in the bear market. The strategy is go in the money. Reddit is 47.56. We're crashing. We're in the bear market, right to 45 or the 40 cover call.
Right.
Why? Because you're getting paid more money that gives you a buffer.
Right.
Buffer. BUFFER. Can you look at some option chain right now?
Yes.
Look at Reddit, RDDT. Tell me for May, stock is 47.56. Tell me the 40 cover call in the money for May. 40 strike cover call.
The 40 is 980.
980. Watch this. Let's say, you're a prepper. We're waiting on this crash or it's crashing. Either way.
Right.
You have 100 shares of Reddit. You want to be safe. You don't think it's going up. It's like I think it's going down. I'm not positive on the stock. I'm not positive on the market. I think we're correcting. Right, the 40 cover call, okay,
right.
At 980. What does that mean? If you bought them today for 47.56, 980 makes it as if you bought the shares at 40 plus 980. Your price is 49. It's like you buy it for 40 and you sell it for 49.80. Why? Because you add your premium to the mix. Okay.
Right.
So I'm sorry, I misspoke. You buy the shares at 47.56, which is today's price.
Right.
You write the 40 cover call in the money, deep in the money. You're gonna get
Right.
980. So it's like you buy the shares for 47.56 and you're selling them for 49.80. That's what's happening. That's the actual trade. That's what's really happening.
Right.
Deep in the money covered call. Now, why? Because look, I didn't get the 690 on the covered call. I didn't get that. But I got 980 and I'm gonna lose 756 on the share growth.
Right.
But seeing that I'm getting 980 on the premium, I'm still getting a positive return of $2.24. You follow me? Because 47.56 plus 224 is 49.80. And you get 980 again for the premium. So it's like you're buying the shares at 47.56 and you sell it for 49.80, you're getting a total profit of 224.
Right. I
Now,
got you.
can you do some math?
Yeah.
224 divided by 47.56. 224 divided by 47.56.
47.56. That's 0.047.
4.7% return. Now,
Right.
Kerwin, this is why you want to go in the money, okay?
Yes.
Because you don't get, first of all, you don't get the 14% return,
Right.
like you did in Coca-Cola, but you get a 4.7% return.
Right.
And here's the catch. I want to be very clear about this. If the stock drops, you're okay because you really already sell it at 40. You buy it here at 47. You really sell at 40. You're getting a 4.7% return, but you don't lose any money, Kerwin. You don't lose any money if the stock drops to 46, 45, 44, 43, 42. It can drop to $40. You still don't lose money. The only way you lose money if it drops to 39. Then you start losing your premium. 38. Because why? Because you were paid to sell it at 40. So the good thing about going in the money on a cover call is you protect yourself from loss. While the average investor is buying at 47, and let's say it drops to 40 or 41, they lost 7 points of share growth. Regular dudes. They're out. They're pulling their hair out. They're like, "What should I do?" We're in the crash, you know. But the deep in the money cover call writer, I'm good. I got paid to sell at 40. I already have a 4%, 7% gain. I don't lose any money.
Right.
So you're protecting yourself from loss.
Right. Gotcha.
Powerful strategy. It's like when you get more and more money dealing with people with more and more higher net worth, they don't notice that they don't want to make a lot of money. They don't want to do anything risky.
Right.
They want smaller returns, more consistent. They want safe. They want safety.
Right.
So that's why deep in the money cover calls is good because you get that protection of it going down, but still with the gain. You're not trying to make, when you have $1 million, you're not trying to make 40% return. Trust me. I mean, some people do, but you want to lower your risk. So whether the stock goes up or down, on a deep in the money cover call, you have protection. You're not going to really incur losses until it goes way down, until it goes beyond your strike.
Right. I got you.
See my Netflix?
Yes.
NFLX. That's a winner.
Yes.
My favorite stock. I want you to graduate to get 100 shares of Netflix by a cover call.
Right.
Which actually, let me talk about another strategy. Don't do this, but I'm going to talk about it.
Okay.
You could, speaking of higher level trading, like level 3 trading, as opposed to level 2, as opposed to level 1, you could buy 50 shares of Netflix. Okay.
All right.
This is what you can do if the stock's expensive, if you can't quite get the full contract, can't quite get 100 shares, but you want to do a cover call. I want you to write it down in your journal. You can buy 50 shares of Netflix and write what's called a naked call. Okay. Level 3
Mhm.
trading is you can write naked calls. So like you can naked puts. You naked
Right.
calls to say that you don't actually have all the shares, or you have some of the shares, or you don't have any shares. You can still
Right.
write that call, but instead of being covered because you don't have the shares, it's naked. So
Right.
when you have 100 shares, when you have 50 shares, in the case of Netflix, you're 50% covered. Okay, that makes
Right.
sense.
Right.
You're gonna get, let's say you get 4% return a month on Netflix, but you get a chance to write the cover call, get that 4% return, but you only have 50 shares. What happens is, let's say, what can you see what Netflix is? 936, 636.
636.18.
Let's say you write to 650. Okay. Let's say you get 20. Can you look this up?
Yeah.
Let's do Netflix. Let's do May. Let's look at the 650 to 660. The stock being 636. Give me a call for the 650 to 660 price.
All right. 1 second. So the 650 is 650 is 32.75 for the
The
bid,
660.
and yeah, 650 32.75, and what was the other one? 655.
660.
660 is 28.65.
Okay, so the sweet spot is where the strike price, I'm sorry, where the share growth is equal to the premium. And 636, 650, that's 24. 660 is 34. So the 660 is a sweet spot.
Okay.
Actually, the 655 is a sweet spot. Can you give me this? Is there a 655? No, right?
Yes, it is. It's
Give me the 655.
30.65. 30.65.
30.65. Why?
Yes.
Because the distance between 636 and 655 is 29 points. And the premium is 30 points. So see how that's very equal? So do the math. Do 30.65 divided by share price of 636. What's that? $30.65 divided by 30.65 divided by 636.
About 636 is 1084. So
What's that?
8.4%.
What?
0.084. Oh, wait a minute.
Okay, that's not right.
No,
30.65 divided by 636.
636. Wait a minute. I got a little dyslexia going on.
30.65
Okay,
divided
there
by
we go. Means
636.
0.48. I'm sorry. I did 36. I'm sorry.
48.
I got it.
4.8. You moved the decimal.
4.8.
Move the decimal over twice. 4.8% return. Okay, so that's a good return. So instead of getting 4.8% return, like you buy 100 shares of Netflix at 636, you write the 655 cover call strike for May, 6 weeks. You get 4.8% return, which is good, great actually. Premium $30.65. Agree to sell it for 655. So if the shares go up from 636 to 655, you get all that share growth.
Right.
You're giving
Okay.
away the upside. You're giving away beyond 655. You're giving that away if it goes up. But you still get the premium 30 points, still get the share growth if it goes up. But here's the naked call. You only have 50 shares on Netflix. So now it's tricky because you'll get the 30 points, and actually the return is higher because if you count that you're only paying half, right?
Right.
So now it's going to be 4.8 times 2 is 9.6% return. Now we're approaching the Reddit return, 9.6.
Right.
But if the stock were to swing past 655, Now you're going to have a loss because you're only protected for 50 shares because you have those shares. But there's other 50 shares that you don't have. You're going to have to pay for those. So it's trick. Like, don't do it, but think about it.
Yeah.
In this case, maybe you want to write the higher cover call, the 660, 670, 680. Why? Because you can still get more than 4.8% return, and the risk is less. You only have half covered. It becomes a naked call. So that's another strategy. Naked call. Naked call with monthly income. I had a friend that did a naked call on Amazon before the split, and he had 50 shares, so half covered. He was doing great. He was doing great until it swung up one day. Still, he made profit because he's doing it monthly, and he ended up closing his position. But you can always close your position. You don't have to stay there. You know, when you make an agreement to do a cover call, technically you're stuck in that position for a month. But I don't like to say stuck. You say you're really staying there for a month, but you can always close it, buy it back, close it, start fresh. Questions?
I want to go back, rewind a little bit. When you were talking about the sweet spot, and you said something about it being equal, the premium being equal to something. You want to be in the sweet spot. So could you run back over that one more time for me?
Yeah, when you write a cover call, I always teach to write the sweet spot, which is to say that the premium is equal to the share growth in the stock. And what I mean by that is, you buy Reddit for today for $47.50. You want to write, like, let's say the 52.50, 47.50. Let's say, look at the distance from the strike from the share price, from your purchase price.
Okay.
If you pay $47.50 and then your strike is $52.50, that's 5 points. You follow me?
Right. Okay. I got you now.
And if the premium is 5 points, then that's the sweet spot. But the premium is still 7. So let's do this. Let's find the sweet spot for Reddit right now. Okay. Look for May. How much is the 52.50 paying, and then how much is the 55 paying? Just look at the 55. I'm gonna tell you right now. Just look at the 55 for May call. For Reddit.
55 right now, showing to be 480.
480. So that's not the sweet spot because there's more share growth. There's 750 share growth. So what's the 52.50?
It's 550.
So that's the sweet spot, because if you buy the shares today at 47.50, you're going to sell them for 52. That's $52.50, right? That's $5.
Yeah. Right. Okay, I got you. I see what you're saying.
That's $5 share growth potential, not a guaranteed potential.
Right.
That you're looking forward to that, but you can't bet on it. And then the premium is $5.50. So the premium is a little more, but that's the closest. So that's the sweet spot. So I recommend you writing the 52.50, because that way you allow for more share growth plus a premium. And over time, Kerwin, like a lot of people are teaching this strategy, but I'm teaching it a little different. If you were just to write if you buy the shares at 47.50, and you were to write the 47.50 every month, you're going to get more premium, Kerwin. But here's the thing: you're not going to get any share growth.
Right.
And over time, you get this premium, which is still good. I'm not saying don't do it. But when you get a hit in the stock price, let's say the stock price goes down, like we said, could go down to 40, then you lost all your premium, right?
Right.
So when you allow share growth, when you do the sweet spot, you're allowing for the upside. You see?
Right.
That's the problem. Problem with the cover call is you're giving away the upside for a monthly premium. But one day when the stock gets slammed, you're going to have more loss because you never got any share growth over all those times that you wrote the cover call.
Right.
So my training, my system is to do the sweet spot so you have all that share growth potential. month to month to
Gotcha.
month to month. And if the stock goes up, in the case of Netflix, case of Reddit, case of all these stocks, Chipotle, you're going to enjoy that share growth and you're going to be able to hold on to that stock a lot better.
Right.
It's more difficult to hold on to the stock if it goes up and up and you get no share growth. You're doing more premium on the cover call. It's like you're more negative. It's like you're more bearish on the stock. The lower you write that strike on the cover call, the more bearish you are in that stock.
Right.
But the higher you write the strike on that cover call, the more bullish. Because why? Because you're looking forward to that getting that share growth when it goes up.
Right.
So over time, if it's because look, when we vet stocks, when we pick our stocks, our core 10, we're picking great stocks. We're picking stocks going up, big stocks with PE, big stocks with volume, with a 10-year chart, with that has stock splits, that had dividends. So all these criteria makes for a great stock. What? That has an upward trend.
Right.
Over 6 months, over 5 years, over 10 years. So you want to be able to enjoy that share growth.
Right.
Which we expect because it's a great stock.
Right.
These other people teaching cover calls, they'll teach all kinds of crazy stuff, but they're not thinking, oh, it's a good stock. And it could go up. They're not thinking that. They're thinking, oh, I'm bearish. I'm just going to get the monthly premium. But they didn't do all this work that the stock. They didn't do all my 12-course system. They're not considering the stock can go up. They're just doing any kind of cover call, any kind of stock. So everything is perspective. So I'm teaching you the sweet spot. We're looking to get the share growth right because your stocks are great stocks and they tend to go up over time.
Right. I got you.
And that's going to be the best return you're going to get.
Right. Right. Okay.
How we doing?
No, well, I do have another question. More on, I guess, kind of a housekeeping type deal. But writing cover calls, do you, let's say, write those in their own separate account? Because I mean, I have a margin account that I trade with, but I also have a cash account and I also have an RA. So do I just write that in the margin account along with my other trades that I might do in that account, or?
Short answer is yes. Short answer is yes. But you should have all your accounts margin, meaning that you have margin potential. When you say a cash account, are you saying you can't do margin, or are you saying you don't do margin in your cash account?
In the cash account, you can't do margin. But I have a margin account and an RA that I believe the RA is the margin account also.
But why do you have a cash account? For what?
Well, I got the cash account for when my account was actually below 25, and I can day trade in it and I don't have to worry about getting hit. You know what I mean? Which I'm not so worried about.
Now you can't do margin.
Yes, I can do. Yes, that's how. I mean, I've had that account to day trade in, so I wouldn't get hit day trades on my margin account back then. You know what I mean? So I still have that account. I didn't close or anything,
but now you don't have 25K.
I do.
Oh, you do?
Yes.
But that's your cash account.
No, the 25 was in the margin.
Okay, on your cash account.
Uh-huh.
Why do you have a cash account?
Well, that's what I'm saying. That I've had it before I had the 25 where I could day trade. See what I'm saying? I've had the account for quite a while.
No, but why though?
To day trade it. Yeah,
but that account has lower value, right?
Yes. Well, you don't have to have a certain amount to day trade.
So call your broker. Tell them that you want to upgrade your cash account to margin.
Okay. Gotcha.
Because cash account doesn't really serve you that much. Sometimes traders get restricted. Sorry, the plane.
Yeah.
So traders get restricted for the reason, or they don't have all the level of trading. Cash accounts like level 1 trading. It's not really desirable. So get that upgraded to margin. I'm not saying you have to use margin, but you want to have margin potential.
Right. Yeah. I never trade with margin though.
However, back to your question, a lot of traders do have a cash account, or the account that they use just cash. like you said, option trading.
Mhm.
And another account that they do margin, they do cover calls and other margin trading. So it's different.
Right.
And you have 3 accounts. That's good. So, the IRA, safe trades,
Right.
low risk. That's your retirement. So low risk, right?
Right.
Cash account, cash trading, more risk. Margin
Right.
account, in the middle, you're doing cover calls. You might buy a little bit more because you might go on the margin a little bit, Instead of getting
Right.
3 contracts, you get 4 contracts, a little bit of margin, but you're getting income on the cover call, so you're paying for the margin.
Right.
Do you know how much they charge you for the margin?
How much they charge, I don't know.
It's about 10% a year, right? And if your
Right.
margin, if you have 10K and your margin 50%, meaning that you buy 20K in stock, you have 10K margin, and that's going to cost you 10%. Cost you $1,000 for the year. So if
Okay.
you're borrowing 10K, so it costs you $1,000 for the year, so it'd be like $800 a month. I'm sorry, $80 a month margin fees. Now, if it's 100K, that's $100 a month. So it does add up. But if you're getting Reddit returns or Netflix returns, it's a no-brainer. You can use the
Right.
margin, not too much, because
Right.
if the
Right.
stock gets slammed, you're losing double faster money.
Yes.
But look, like I said, not more than 30%. Write this down: 30% margin max. So if you have 10K, you can buy 13K in stock. You have 100K, 130K in stock. Because if you do margin double, let's say you do double, right?
Mhm.
You lose twice as fast. If the market corrects, your stock corrects, man, the whole account's gonna get wiped out.
Yes.
So protection,
Yeah.
safe trades.
Yeah. I know someone that happened to. So I watched it and I learned my lesson through him. So got you.
You got 3 accounts in your IRA, safe trades, and you can do cover calls in your IRA.
Yes. Yeah.
Like
I'm
you
level
said,
3 on my margin accounts. Yes.
what's that?
I am a level 3 on both my margin accounts.
Wonderful. So your accounts are for different things.
Yes.
IRA, safe trades. Maybe you buy Starbucks. Safe cash account. Doing cash trades. Risky. More trading. In the margin account, maybe doing some cover calls. So for different things.
I got you. Right.
How we doing?
You're doing well.
About ready to
Learned a
wrap
lot.
up, right? You have any more
Yes,
questions?
sir. No, I think we pretty much covered it today. Yeah.
Okay, we covered. We talked about Netflix. We talked about Naked Call. Talked about Chipotle. Chipotle's going to split 50-for-1 in June. Get ready for that.
Yeah.
Talked about Reddit. You're doing great. Cover call return on Reddit. It's a lot of hype. That return could come down. The stock could go anywhere. We'll see. Stay with it. Talk about Starbucks and why it's different. Why the company's good. There's still a lot of growth potential in Chipotle, even though it's $3,000 a share. It's funny.
Right.
You have to get the right perspective. The stock is $3,000 a share, but the market cap is only 70 billion. So the market cap, it could still double or triple. They open up 500 more stores. That $3,000 stock can go to 6,000, 9,000, easy.
Right.
Just look at these stocks that have grown. Just look at Tesla. Look at Apple. Look at Netflix. Go way back.
Right.
20 times return, 50 times return, 100 times return.
Right.
Sound good?
Sounds good. Well, you know what? I do have one more quick question to sneak in on you. Now, man, I know I told you I was trying to find me a cheap stock that I can just buy and hold. Well, I kind of settled on one, and I'm just going to buy it and hold it. Would you buy it in your RA or
What is it? What is it?
it's SOUN. It's an AI company. They're sitting about $5 right now.
SOUN. I'm gonna guess there's no premium. There's no earnings, no profits,
No profits, no.
no PE.
No.
SOUN.
Yeah. I seen the
That
video.
sounds like
A lot of their shares, Boston
that sounds
shares
like
of there.
either a cash account or a IRA.
Okay.
But I'll tell you, those stock it's on the Russell 200 2000.
Yes. No,
Those
I think
stocks.
actually I think that's the Nasdaq actually. I think. Let
See
me
if it's
look
on
real quick.
the find out if it's on the Russell 2000. Okay.
Let me look real quick.
No, not right now.
Okay.
Later
go
on,
ahead.
and let me look into it. But like these stocks, gotta be careful, Kerwin, because $5 stock, the quality is not there. You're looking for a long term potential, but it's more like a long shot, right?
Yeah,
And by the way, does it have an option chain?
it does.
So that's good. How long has it been trading?
For a little while. I don't know exact, but it's been trading for a while.
That's okay. More on that next week. Just be my advice: be careful.
Yeah, I'm not gonna go in super heavy on it. It's just something I want to buy like 200 or 300 shares and just put it over here to the side and see what happens with it. You know what I mean? I'm not gonna break the bank on it or nothing like that. You know what I mean? So
because let me tell you why be careful, because I'm thinking your mentality is it can go way up, but you got to 1,000 stocks have come and gone in the face of, let's say, Apple. 1,000 stocks have come and gone in the face of Netflix, in the face of Amazon, and you're trying to pick one of those 1,000 thinking it's going to be the next Amazon, going to be the next Apple.
No, I'm not. I'm not quite going for that, but I'm just
long shot.
looking for some share growth.
However, look into the cover call. Sometimes these $5 stocks can pay 10, 15% cover call.
Right. Okay.
That's a possibility, but then you may not want to do cover call because you want money to get that share growth. But if it hasn't done nothing in the last 10 years, if it's $5, what's it done in the last 10 years? I guess.
Yeah.
So how can you expect it to go in the next 10 years? But you could get lucky. So just be careful. So
yeah. Sounds good.
With that, we're gonna wrap up. See you next week. Text me, call me, do your review on the video. I'll send you the video. Rewrite your notes. That's your homework. Thank you, sir.
Thank you, sir. You have a good same to you.